Hi, welcome back. These last few sessions, we've talked about lots of different investment philosophies, ranging from value investing to growth investing to charting to trading on information to arbitrage and even market timing. And in all of those, we looked at the good news, we looked at the bad news, but they were all presented as active investment strategies where you're trying to beat what you can make by not taking those actions. So in this session, I want to focus on passive investing. What happens if you decide that none of these philosophies work for you? And you might reach that conclusion, even though you might start off life believing that you can make money as a value investor. After 5 or 10 years of trying, you might say, hey, this isn't working for me. So in this session, I want to focus on the case for passive investing. And the best way to make that case is to look at the results from active investing. So in fact, if you look at active investing and you look at whether investors can beat the market, you can look at it in subsets. You can look at whether individual investors or active investors beat the market. And you can also have a second test, which might be a tougher test. Can professional money managers, mutual fund managers, hedge fund managers beat the market? So let's start with individual investors, and let me give you the bad news first. The bad news is if you look across all individual investors, the average individual investor doesn't beat the market after netting out costs. In fact, a study that looked at thousands of brokerage accounts between 91 and 96 found that the return you'd have made on the S&P 500 index fund over that period would have been about 17.8%. So think of that as the return you'd have made by investing in an index fund. And the average investor trading at the brokerage house had a net return of 16.4%. So all that activity resulted in a loss of return of 1.4% a year. The second finding from this study was that the more individual investors traded, the lower their returns turned out to be. So the more activity you put in terms of trading, the lower your overall returns are. And third, pooling the talents and strengths of individual investors into investment clubs doesn't do much better. In fact, a study that looked at investment clubs over that same period found that they underperformed. Their return of 14.1% underperformed not just the S&P 500, but what individual investors made. That's a scary thought. Pooling individual investors actually creates some reverse synergy in this process and actually makes you a less attractive investment fund. Something to keep in mind as you put together groups of 3 or 5 or 10 people and start investment funds. It might not always work out the way you expected it to. Here is some potentially good news. So it's not that good. You can't be dancing in the streets. The first is that study that looked at individual brokerage accounts found that the top quartile, the top 25% of individual investors did outperform the market by about 6% a month. That's pretty good, right? 6%. However, that top quartile is it's a shifting quartile. It's not the same investors who show up in the top 25% all the time. Second, studies have found that investors who stay close to home, physically close to home, invest in companies that are geographically close to where they live, tend to earn higher returns than investors in companies in distant areas. Don't ask me why. Maybe you have access to insider information. Maybe you really know your company, and maybe this is just it just backs up the fact that when you invest, you really should know the company you invest in. And in fact, a follow-up to that is a study found that investors with more concentrated portfolios outperform those with more diversified portfolios. So if you're going to pick stocks, it says you can't pick 100 stocks. You got to pick the 10 or 15 best stocks and hope you did your job. One final piece to note here, a study of 16,668 individual trader accounts at a brokerage house found that the top 10% of the traders outperformed the bottom 10% by 8%. Again, that isn't saying much because unless you can show me that the same people show up in the top 10% and the bottom 10%, all that'll mean is you'll have winning years and bad years. But overall, there are some glimmers of hope, at least, with individual investors. You say, what about mutual funds? Professional money managers claim to be the experts in the field. They have access to stuff that the rest of us do not have. Especially 20 or 30 years ago, they had access to much better information at lower transactions costs, and presumably they were smarter than the rest of us. So the presumption for a long time, at least in the early years of mutual funds, is they must do better than individual investors. And nobody really bothered to test this proposition. They just took it as a given. Until Michael Jensen, in the 1960s, did one of the most famous studies in finance. What he looked at mutual fund returns relative to the market, and he adjusted for risk. He said it's not just fair to just compare them to the S&P 500. he adjusted for risk. He computed a measure which is still called Jensen's alpha. He took the actual return on these funds and computed the expected return you'd have on the funds given the risk-free rate and the actual return on the market and the beta of these funds, and he computed the difference. So the way to read this graph is this is a distribution of what he found across the 125 funds he looked at. So a number above 0 means you have a fund that actually beats the market. A number below 0 means you have a fund below the market. And you can already see, looking at this distribution, that about 2/3 of the mutual fund he looked at had delivered returns that were lower than the market, had negative excess returns, negative Jensen's alphas. The average across all mutual funds in his study was a negative number. The average mutual fund underperformed the market. That laid the foundation for all the studies since looking at mutual fund. It's amazing how little the consensus results have shifted in the 40 plus years since the Jensen study. Okay. In fact, there are studies that have looked at bond funds and come to the same conclusion. The average active bond fund underperforms a bond index. So activity is not just bad in the stock market, it seems to be bad even in the bond market. At least on average, active stock funds and active bond funds don't match their index counterparts. Now, of course, in the years since, people have come back to these studies and looked at measurement issues. One issue that they've looked at is the original Jensen study used the CAPM and betas to measure risk, and maybe that's not the right measure of risk. Maybe the reason we're finding that mutual funds underperform is because we use the wrong risk measure. So there have been people who've tried other risk measures. In fact, a very simplistic test that's been applied is, let's forget about risk measures. Let's just compare how a money manager does relative to the S&P 500. So this is actually a graph, a very simple graph that doesn't control for risk, looks at the percentage of money managers who beat the S&P 500 every year. Remember, 50% is your threshold, right? Look at how many years you've had in this time period where professional money managers have actually beaten the S&P 500. There's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, barely 12, 13. 13 out of the 50 years, or 13 out of the 40 years, more than 50% of money managers. There are years where only 21% of money managers actually beat the S&P 500. So even without controlling for risk, you know that looking across this graph that most money managers don't beat even basic indices. If you control for risk, and there have been studies that have used variance of the CAPM, people have looked at Sharpe ratios, returns on mutual funds divided by the standard deviation, trainer measures. We divide the excess return by the beta, Jensen's alpha with updated numbers. All these studies come to the same conclusion that Michael Jensen did, which is the average mutual fund underperforms the index. People have used the arbitrage pricing model. In fact, one study that used the arbitrage pricing model found that the type of excess return they got was a function of the model, but with every variation they used in the model, the average mutual fund manager underperformed the market. Pretty depressing news, at least on average across all mutual fund managers. In fact, about 20 years ago, you started to see proxy models come into play, where essentially researchers found that there were variables that systematically explained returns even after you adjusted for traditional risk and return. And that included things like low price to book ratio stocks, earned higher returns than high price to book stocks, low market cap companies, price momentum. These are proxies. So in 1997, in a very well-known study, Carhart used a 4-factor model, where in addition to beta, use market cap, price to book ratios, and price momentum as factors to see if, in fact, using these 4-factor models would change the findings on money managers. And he found that the average mutual fund still underperformed the market by 1.8%, even after you control for these proxies. Okay. Now, the second issue you often run into when you look at mutual fund performance is survival bias. What we mean by that is the really good mutual funds continue to survive, the really bad mutual funds fail. So if you just take the average returns across surviving mutual funds, you're going to get too high a return because you're missing the fact that the mutual funds that failed had much lower returns. So the same Carhart study also took all equity mutual funds and looked at how much effect it had, not including these failed funds in your analysis. So over that entire period, about 3.6% of funds failed, and they tend to be smaller, riskier, and worse performing than the typical fund. And if you look at the non-surviving funds, as I said, 80% of those non-surviving funds underperformed other mutual funds in the 5 years before the failure. So Carr actually estimated how much your average returns would get overstated over the period. And his conclusion was that if you just computed average returns across mutual funds without controlling for the failure, you'd end up with returns about 0.17% higher than the actual return of the 1 year time horizon, and more than 1% with the 20-year time horizon. So if you control for survivor bias, things look even worse for mutual funds in terms of the returns that they deliver. Now, of course, if you bring this result up with mutual fund managers, they're always likely to argue that that might be true on average, but it must be different across subgroups, that there must be groups of mutual funds that do better. So since mutual funds come in all kinds of varieties, I think it's worth looking at whether the findings are different if you start slicing and dicing mutual funds by type. So here's the first one. This actually looks at mutual funds classified by the market cap of the companies they invest in. So what this study actually looks at are mutual funds that invest in large cap companies against a large cap index fund, mid cap companies against a mid cap index fund, and small cap companies against a small cap index fund. It has 10 years of data, but let me focus on the numbers that matter. It's in this very last column, and it looks at the percentage of funds that beat their indices. So perhaps the most optimistic note here is if you look at large cap mutual funds that invest in large cap companies, 43% actually do better than the market. You're saying that's terrible, 57% don't, but that's your best scenario. Mid cap funds, only about 36 or 37% beat their indices, and small cap funds even worse. So if you look across market capitalizations, it doesn't matter whether you invest in large companies, mid cap companies, or small companies. Across the board, mutual funds seem to underperform their indices. That surprises people because the intuition seems to suggest that if you're a mutual fund manager investing in small companies, your odds must be better, right? Because those are the companies where mistakes are most likely. Well, the returns clearly don't reveal that. Now, if you categorize based on investment style into growth funds and value funds and yield funds, which go after dividend yield and other, and you look at the annual returns and the percentage of managers beating the index, basically you find the same conclusion. There's only one group where more than 50% of the managers beat their respective index, and those are yield funds, where 56%. Every other group across the board, you find more managers underperform their indices than outperform. If you then look at emerging market and international funds, so you look across emerging markets, again the presumption is if you're a mutual fund manager in an emerging market, you must have a much better shot of beating the index because there's so many inefficiencies in that market. Across the board, whether you're looking at Asia, Latin America, or other emerging markets, the results stay the same. There's the active mutual fund, there's the index. In every one of these markets, again, the index outperforms the average active money manager. If you look at load funds versus no load funds, for those of you not familiar with this distinction, in a load fund, when you invest in the fund, a percentage of your money gets taken by the fund off the top. So presumably you're paying the load because you think these funds can do better than funds where you don't face that load. Well, if you look at the gross returns, even before you adjust for the load expense, the no load funds actually underperform by less than the load funds. They both underperform, but the no load funds actually underperform less. And if you factor in the load fee, it's a no-brainer. Investing in a load fund is asking for disaster. On average, these load funds destroy value at an exponential rate. I mean, you lose 3.5–4% a year, you're very quickly going to see your portfolio get wiped out. And if you classify funds based on fund age, funds that have been around a long time, middle-aged funds, young funds, every category you find underperformance. Actually, the youngest funds underperform the least. So maybe the longer funds are around, the more experienced money managers get, the worse they do. That's actually pretty depressing because you'd think with age comes some kind of experience that helps you, but doesn't seem to show up as higher returns. And finally, if you look at institutional versus retail funds across the board, again, every one of these groups underperforms the index. There's only one subgroup. Big standalone institutional funds, where if you look at the excess returns, it's slightly, very, very slightly above zero. So if you're looking for good news in these results, there's obviously very little good news. Overall, across the board, you look at funds, you look at mutual funds, the performance doesn't quite match up to reality. Thank you very much for listening, and I hope you found this instructive, if not enjoyable. Clearly, there's a lot of bad news in here, but that's the way it is.